Okay, it's Brian here from quantlabs.net. Got a bunch of questions for you guys. I don't know if you guys can help me out as I build up my internal trading system here. Hopefully you guys can learn some stuff in the process. Looking for experience from you guys. Last week you guys really helped me out. So tonight what we're talking about is basically risk parameters. We talked about risk management, but this is different from risk parameters and how you apply it to your trades as you open up new positions, and how you basically manage the risk on your trades and your portfolio. This is a sort of topics I've never seen talked about before, so this might be new ground for a lot of you guys. Hopefully some of you might be experienced and you can help me learn this too, and we can go over it. Okay, so like I said, I got 13 questions here. Some of these are very specific. The first question I purposely made easy. Now, like I said, there's a little chat box here if you can't speak. And let's just talk about each point here. So the first one is, how many of you guys are actually allocating a percentage on how much you are willing to put at risk for each trade on your total portfolio, and what's that percent that you allocate for each position? Anybody want to give me a figure? If it's 5%, 2%, 10%? Go ahead. Yeah, go ahead, Jeff.
Yeah, 2% on every position.
You said 2%. Okay. Edwell says 2%. Okay. Shalom says 2%. That seems to be universal. Now, does that include margin as well?
Yes, it does.
Say that again, Shalom. Sorry.
I don't use margin.
Okay.
I use options. So.
Okay. Well, we'll talk about margin and exposure of that in a bit. All right. So let's get on to the second question. Now, I don't know if anyone actually does spread trading, and if so, how do you guys hedge out the risk, and how do you factor in the different views on your global, regional, and sector view, and how you approach each one? Does anybody have any answers on that at all, or any guidance?
You create, Jeff and Sam Fran, create a spread between the two, right?
Yeah.
And what I do is I run my system through it. That's how I do spread trading. So between different bond markets.
Yep.
Between Germany and Euro and US, and between different parts of the curve up and down the curve. So I'm taking views, systematic signals from the system.
Okay. How do you factor in hedging your risk though, or hedging out your risk, or at least reducing it?
Basically, I use I like call them trailing stop at risk levels.
Okay.
I might be maybe 2.1% away, 5.5 away, right? 8.5 away, then the next one's 8.9. So you use 2.1, 5.5, and 8.9.
Okay.
Just levels, because the only thing I like ever.
Sorry, Jeff, you're breaking up there. If you can hear me.
That I use is different levels of risk.
Yeah.
2.1, 5.5, and 8.9, because I do not want to take any more than 10% of risk in any position in the sense of drawdown.
Right. Now that's 10% of your total portfolio, including margin?
Yes, of the position, yes.
Okay. Well, let's talk about margin now. Now, how many of you guys actually use margin out of the group? Just give me a yes in the chat box. Patrick, Jeff, anybody else use margin? Anybody else? Who's not using margin, just doing one-to-one? I know Ernie Chan does that. Okay, Edwall, Shalom. Okay. Now, if you're using margin, I think we kind of talked about it. What exposure levels do you limit yourself at, and at what times? Now, I know, Jeff, you're a fixed income guy. You probably don't see it listed here, but anybody else outside of fixed income, specifically for what's your margin? Sorry, go ahead, Jeff. Sorry.
Yeah, fixed income and foreign exchange.
15 times for foreign exchange.
Yes.
Okay. Anybody do large cap stock or commodity, and what's the upper limit you put on those on your margin? Anybody? Because there are upper limits on. I'll be doing a whole video on this probably the next few days just to go through this. Guess nobody does that. All right. What about tolerances that your broker will allow? Percent wise, I'm looking at. What do you think your tolerances are before percent wise before your account's technically blown out? So let's say 100% or sorry 100 times 1% movement can ruin you. Does that sound about right for a lot of people? Because typically you'll see a lot of brokers at Forex that will allow you to be at 100 times. Anybody agree with that?
It depends on the broker. So for example, my brokers allows me 400 times leverage.
Okay. So would that mean
It really depends.
but in terms of the percentage of the drawdown, like 1%, could that take you down?
When you use 400, 0.25% can take you down.
Yeah, that's what I meant, yeah. Okay.
Yes, it can take you down.
Okay. Now with you guys, what are your upper limits on your tolerance risk, like with margin? How much are you willing to put out there for like a self-imposed limit on Forex? What would you say, Gigi? Are you still at 400 times?
It really depends on. No, I have access. That doesn't mean that I use it.
So what would
For
your
example,
go ahead.
right now, because like I said, what I'm trading is very special strategy. Right now, I am at 100 to 1 leverage, so I'm using it 100. So 1% move will actually wipe me out,
Okay.
but that's really unlikely.
Okay.
How do you manage the risk? If a 1% move would wipe you out completely, how do you manage that from a risk standpoint?
Because if you remember, I trade the Swiss franc, which has a hard limit on it, and to get to 1% against me, you have to go below that limit. So I'm actually presuming that that limit will hold. So this is how I manage risk.
I don't follow you. The limit is that a stop limit or is that what kind of limit is that? I don't know.
No, it's the Swiss central bank, the central bank of Switzerland, that the currency will not go beyond that limit. So my stop is below their limit.
Right, but that means that they're not always perfect. They may not hold their limit may be busted.
They will hold. They hold it in 2012, and they will hold it again.
Wow, I mean, so you're basically banking all your money on their policies.
Well, I did with this strategy. I actually did go. I did have a 90% drawdown, and I recovered it all. So if you remember from that, when you have a 90% drawdown, to recover it all, you have to win back 500% or something like that.
Right.
Or 900%. Because you need to make a match. And I actually done this. Because like I said, that it's a very special currency. So, but that doesn't mean that you can use it always.
Yeah, I just couldn't sleep at night trying to just bank on the Swiss government. That doesn't,
So basically,
what if they change the policy? What if their policy changes?
This is a much more complicated fundamental discussion. My analysis, which was a very deep analysis, told me that this will not happen, and I was right for 3 years. Of course, some people may disagree, but I actually sleep better taking 100% risk on this currency than taking a 2% risk on the euro dollar, for example.
Okay.
So when I had position 75 smaller than this position, I actually couldn't sleep at all, like you said, at night on the euro dollar.
But if you can't make your position, you're definitely in the wrong position, that's for sure. That's not a good position to be in.
And I also, there's another thing of risk management. The famous saying, don't risk more than you can afford to lose, right?
Right.
I can afford to lose all this money. So I don't have mortgages, I can easily get a very high paying job as a programmer. So that's my backup plan. It's not like I will go in the street if I lose this.
Right, but you'll be out of trading for a while, right? While you rebuild your capital, you won't be able to trade.
Of course, but this is a calculated risk. So the risk of this strategy failing is so small that in my opinion it's worth taking it.
Okay.
Interesting.
I've never heard that strategy being used before as a risk management thing, but hey, if you could sleep at night with it, then I guess it's okay.
That's why we're here, Shalom, to learn stuff. We got some.
It's not for me, Brian. Don't try this. Don't try
Do not try this at home, right?
Don't try it at home, kids.
So Patrick says the government bank, unless he will stop trading it. Okay, that's a comment to you, Gigi, I guess. Mike says,
don't understand. Anyway.
go ahead.
No, I didn't understand. He was referring to something I said, or Patrick.
Right, and then Mike says, note for Americans, only 50-1 leverage is available for FX. Non-Americans can do 100-1. Non-regulated ECN's liquidity providers.
Yes, Americans are only allowed to trade like 50-1, and
Yeah.
that's on the majors. On the more exotic pairs, like 20-1.
Yeah. Freeze.
50-1 should be plenty of leverage. London Quant told me the maximum he'll go is 20-1, and that's the absolute maximum.
Yes, like the maximum when I went on the other currencies for me was like 15-1, so very low.
I'm 21 in FX as well.
Yeah. There's different limits for everybody. Now, anybody who's trading large commodity or large cap or commodity is looking for your limits. Anybody? Guess not. Max exposure. How many active trading positions will you allow to protect your account capital? So whoever's an active trader, how many positions are you willing to put out there to protect your trading account? Anybody have an upper limit on how much they're willing to risk?
I think it's really percentage of capital, not positions, right? The positions don't matter, right? It's what percentage of your capital are you risking. I think that's the key.
100%.
And you mean in the same instrument or in different instruments?
This is for your total portfolio.
Well, it depends on your strategy. So, for example, Nassim Taleb has his 20-80% strategy, where he puts 20% of his money in very risky stuff and 80% in cash. So it really depends on what your.
It used to be 90-10. I remember he used to tell people put 90% of your money in 90-day T-bills and in bank accounts, and then the remaining.
Well, 90-10, 20-80 is kind of the same thing, right?
Well, it's a big difference between 90-10 and 80-20, but.
I remember it being 80-20, so. But maybe, I don't know. This is also called the barbell strategy because it has two very large ends and nothing in the middle.
Right.
So I guess the next question, what happens when volatility kicks in? How do you protect your portfolio? And if that's the case, what's the maximum standard deviation that you allow before you're technically knocked out? Tongue twisters, eh? So how do you protect yourself when volatility goes crazy? Anybody got an answer on that?
Deviation stops.
Sorry, Jeff, go ahead.
The deviation stops set at 2.2, 5 point something, and 8 point something. Just deviation away from current closing price. Well, current price in the market.
Okay.
Or it's changing depending on where the market is.
Okay, so that's cool. But what do you do when you start breaching those? Do you have like a little panic button that you can press that will liquidate everything?
Stops me out.
Oh, it stops you out. Okay, that's fine. Anybody else? Mike said.
You have to prepare for any level of volatility. So your strategy has to take into account black swan events.
Yes, but you have to be careful not to have opportunity because there is very interesting stuff that I learned from a high frequency trader. So he told me, I mean not me personally, but on the web, he told something like, it makes sense to risk more money than most people expect most of the time, because the thing goes like this: if you risk more money than, let's say, 2%, you'll win a lot of times, and you'll win X amount of money, then you lose. Okay. The thing is that if you win a big percent, then you can lose much more than the guy who win little percent, and then who lost 10%, for example. So there is a school of thought which tells you to actually risk. It makes sense to risk more because you win much more money from that, and you have a higher position from which to go down.
Yeah, but Nassim Taleb says that doesn't work. Usually You can make 2% for a long time, and then in one day you lose 6,000%. It's the way
Exactly.
behind.
But what if you make 10% of a lot of the time?
You have to do the mathematics. You just have to make sure you're covered. You just have to make sure that you don't get wiped out, in an extreme event.
So this is why high frequency trading works so well, because they win so much, so little times, so many times, that
Right.
when they'll have their 90% down day, there's the 10% that will remain will still be much, much more than the average investor, because they won so much over the time.
If you're a high frequency trading firm, you shouldn't have a 90% down day because you're basically making.
This is the black swan you're talking about. So when you have a black swan like the nightmare which happened, when you
Right.
have like a huge failure,
Flash
that
crash.
day, you'll still have so much money historically that you'll still be very profitable.
Right. This is true. I mean, the market could collapse in it like a flash crash kind of thing.
Yeah, that's what Mike just said. Yeah. Mike
You're
just.
right. That is the risk of high frequency trading.
But here's a question for you guys that Mike asked. So how much do you put at risk per trade based on volatility levels? And this is to you, Gigi and Jeff.
So my answer was simple. I put 100% at risk, and I don't look at volatility because it's a very special strategy. So
Right. Jeff just
I
dropped
have a
off.
fixed amount of risk.
Jeff just dropped. Well, I just thought of another question for you guys. Have you heard about for automated trading where, let's say, interactive brokers I've heard through the grapevine that if you have a system or a client that's taking on more risk as a trader, willing to take on more risk of losing, that the broker will put those trades at the higher priority on the trading book to execute the trade faster. Have you guys heard anything like that?
I'm not sure if that wouldn't be illegal based on their trading conditions. So very interesting.
Because I've heard that's what's happening out there. Those that are willing to take the risk get better execution and higher priority as execution as well. Nobody's heard that?
Some future brokers, like Infinity Futures, have lower margin requirements because their system will stop you out quicker if you get into trouble.
Okay.
So that they have their own risk controls. But futures, there's different regulations than you have for equities. So, for instance, you can day trade futures on a 10K account. The SEC won't let you do that with equities or indices. So, there's different regulations depending on the instrument you use.
However, this thing that prioritizing some traders kind of sounds illegal in the States. So
What's illegal doesn't mean it's going to get caught, right? So.
I'm not sure that if people talk about this, I'm not sure.
Brian, over time, they're more likely to get caught, right? It's like volatility. Every day the probability of a flash crash is very unlikely, or in a week.
Yeah.
But if you take years at a time, like in the next 5 years, another flash crash is sort of likely, right?
Yeah.
But today we have those breaking levels. I don't know. I forgot their name, so it shouldn't happen anymore.
Circuit breakers.
Yes, circuit breaker.
Because Patrick's.
Yeah,
Yes, it can happen at 10%, but then the circuit breaker will cut in. So.
Right. Well, that's going to help high frequency traders. That's definitely going to save them because they can, reset their algorithms and stuff during that time. But then again,
there were still people at the other time because the trades were canceled. So.
Yeah, but I mean, if the market is locked and it's limit down, and then they reopen the market, there's still no telling where the market will reopen if everyone's recalibrating.
If it was a glitch, it will retrace back because the market is mispriced. If something bad happened in the world, it will go down. So.
Well, if there's a panic, it can go down quite a bit. So the market might be down. Let's say
But it was like Jim Trader said, like Jim Cramer said, you buy Procter & Gamble at 18. It doesn't matter. You buy it. The market goes down without an actual reason, without some actual.
Well, yeah, I mean, after the stock collapses completely, then you can go ahead and buy because it's near the bottom anyways. The most it can go is to zero, and the company's worth more than zero. But
especially if you don't use margin, so you are not at risk of being stopped out.
Right, exactly. But let me give you a scenario. If the S&P 500 collapses, let's say 10% in a few minutes, then I believe the government regulations are they hold trading for a half an hour or something like that. So let's say the market's at 2,000, it goes down to 1,800, and at that point, people start to panic. So high frequency traders maybe shut off their machines. People switch around their algorithms. Go
In
ahead.
those 10 minutes, people would look at the news. Why did it go down? Is it a glitch in the market or something terrible happened?
No,
So
no,
I
it
think
could
this
be.
is very important.
Well, yeah, but people also panic. I mean, if the market goes down 10% and there's no reason, that can cause a panic in and of itself, right? Because that should never
But
happen.
then the value traders will kick in and will buy at those lower levels.
I mean, you're guessing what other people are going to do, and that could be the reaction. That could be the reaction, but the thing is how much, it also
So
could be
look at the tweet about the attack on the White House, right? When Obama was injured. It got down, and then people start calling the people at the White House, and some guy said, I'm looking at the window right now and everything is okay. And then the value traders, based on that information, start buying because they knew that the market fall for no reason.
Okay, so let's say your scenario. Let's say it goes down 10%, and then some bad news comes out. Let's say some horrible news comes
Well,
out.
then it will go down another 20%.
Right, it go down another 20%, but it might open up 20% down. When they reopen the market, it might be.
But if something bad happens, the market has to go down, so you can't stop that. It's a fundamental reason.
Right, but you may not be able to get out, until it's down.
That's the risk of trading. I mean, there are stories about the guys trading sugar, or when it kept going up or kept going down, and market opened limit up or limit down, and they couldn't exit the position. That's the risk of trading like volatile assets.
Right, but you can prepare for things like that. If you have to prepare for stuff like that by.
I'm not sure. I mean, people, very big firms or companies stuff like this. Or the Amaret trade with natural gas futures, for example.
Well, not all firms will be caught. Some firms will be caught. I'm sure Talib's firm, Universe, is not going to be caught. Hopefully. If he's doing that's called,
Yes, but this is because high frequency traders don't carry inventory, so they don't practically have a position to exit.
Okay,
they carry inventory for short periods of time, right?
Yes, and the inventory is very little compared to their overall capital.
Right. So that's their saving.
So even if they lose all the inventory, they wouldn't lose that much.
Right.
so Patrick says, just so people view this, that with what I referred to on the broker side makes sense. They want your deposits, Jeff said. Employ computational intense algorithms to optimize serial dependency, cycle length, and scale for logarithmic volatility. And Patrick says he traded Japan earthquake.
Patrick, were you on the right side or the wrong side of that trade?
Want to type it up, Patrick?
I also wanted to trade that event, but I couldn't because I was locked in with my capital on the Swiss trading, and I would have got it very right. So I wanted to buy the US yen. So
Your capital was locked up in the Swiss trade because that's what.
it was not totally locked, but if I traded something else, my stop level would move above the guaranteed level, so I would be at risk in case of a big move down. So I didn't touch anything else.
So Patrick came back with a couple of follow-up answers. Said he lost both sides, traded down and scalped, and intervention buying back. You guys want
It was not the Japan because it was most likely the Fukushima event because the earthquake was Fukushima in that case.
Okay. You want to move on to?
I was on the right side of the flash crash, May 6th and 7th of 2010. That was just dumb luck, but it was good to be on the right side of that. Let me tell you. Very profitable.
Okay, moving on to the next topic here. What's your net limit on the initial amount of your account when you initially fund it? So when let's say you get 100K and you're opening up your broker account, how much do you initially fund the account? A lot of the beginners will put in 100%.
You just said the 100K. Is this something I'm missing?
No, like some people put the 100K in initially, but some of the smart guys may only start at 5K just to test out a trading idea or a strategy.
So they put 95K into T-bills or treasuries and get interest on that, and the rest they put into the trading account.
Yeah. I'm just trying to see.
That means that you only have a 5K account. So calling it a 100K account is kind of, I don't know.
Right, exactly.
Yeah.
So it's a 5K account. I like to start with 10K. That's what I do in all my accounts.
But if you have 100K to work with, how much are you willing to put in to the market with a brand new broker account to start with? What do you guys would recommend or do?
Brian, the money that you're willing to put in is the money you have to start with. If you have 100K, but you're only willing to put in 10%,
Yes, you just have 10K, yes.
Then you
No, I
only
think
have,
that's what Brian asked is if you trust your broker with the full amount, right?
No, what I'm asking is, do you trust your trading idea? A lot of newbies will put in 100% of what they have available to start with. From my
that's why
perspective,
they're newbies.
what's that?
That's why they're newbies.
Right, but there's like we already getting answers here. Jeff puts in 70%, Edwall puts in 30%. Anybody else have any other answers? So Shalom says 10% of total brand new. Okay, that's cool. Anybody else? Patrick puts on 100%. Anybody? You guys want to talk about it at all?
I mean, I put all my money. If it's risk capital, it's risk capital. So
Okay.
I don't know.
I think 100% for most people is a bit too risky. Well, not a bit; it's very risky. And I think unless you really have confidence and know what you're doing, you definitely should. 10% is the way to go. I think. 100% seems crazy to me.
Yeah.
But hey, if it's working for you and you can sleep at night, I'm not one to point fingers.
Right. All right. How many of you guys use beta ratio and spread calculation on a long beta stock with an upper value for their hedging? Anybody kind of do something like that? Anybody do beta ratio and spread calculations on their real-time trading portfolio? Anybody know about it? No? Anybody? This can be applied to any type of... Jeff says yes. Okay, Patrick says no. This is why we're talking about this, because a lot of people don't know about this stuff. Okay, for you, Jeff, I guess. Do you do the same for short to calculate the beta of the position spread? Okay, so for bond spread during... based on duration. Okay. Do you want, go ahead, Jeff.
Duration have currencies that adjust to the currencies as well.
Okay.
So if I'm doing European and I've got currency risk, I take that into consideration as well as duration risk.
Yeah. Yeah, we'll talk about that with the currency exchange in a little bit. I just want to specifically talk about this. Do you concern yourself with beta changes as they can impact portfolio losses? And do you also apply stop losses to help reduce the risk? Anybody at all? Anybody?
If I'm trading futures, I use stop losses. For options, I use them for sometimes for selling credit spreads. I use them a bit. But,
okay.
It's better if you have a strategy where you don't have to use stop losses and you're still protected. That's the superior strategy, I feel.
Okay.
But that means only trading like paid up front, like options, right? Or fixed.
Long option spreads, stuff like that, or hedging, some kind of hedging.
But a spread is not guaranteed because the spread can go wider. So
I'm talking about a put spread. It's not going to go wider.
Okay, but this is still an option trade. I thought you mean a spread like between two stocks.
No, I'm sorry. I meant like an option spread.
So basically, beside trading options or like option like products, you can't actually have fixed risk.
Right. It's very hard to trade without stops and have a risk management system and not use options and not be long options. I don't know. I'm not sure how you would do that. So.
Going long stocks could be considered something that's without leverage. So.
Yeah, you could go long stocks, but you're deploying a lot more capital then.
Yes.
The stocks are a lot more costly than the options.
Well, here's an interesting topic that Patrick mentions, hedging algo. If you want to talk about that, Patrick, I don't know if you're able to speak.
Yes, but that's not guaranteed. That's only it's likely to work, but it's not a guarantee to work.
What, hedging algo?
Yes.
Okay.
Because the market can move faster than any algo, so
True.
But the problem with hedging algos is you have to keep track of the correlation. You have to continually recompute the correlation.
But you got to realize Patrick may be trading on a it depends on his time horizon what he's trading on. He could be trading on.
Brian, whatever time horizon he's got to continually reproduce.
Do you know about the August quant crash in 2007?
Go ahead.
So there was this algos, there were these hedge funds which were all doing the long short trading algorithm, and the market didn't move. The market stayed neutral at all time, but because some hedge funds started to liquidate their position, the spreads were pushed wider, and practically everybody started to liquidate, and this just kept on growing. So the market stayed neutral for the whole month. All funds had something like 90% drawdown, and they were all hedged, and they were all long and short at the same time. And how could this happen, right? So you can research this on the internet. It's a very, very interesting topic of how this market neutral strategy, they all blew up at the same time.
Okay, hold on.
Because the spread was pushed wider.
Let's time out for a bit. I'm very interested to hear about what Patrick is doing on a hedging algo. If we can just give him the opportunity to talk about it. Are you able to speak up, Patrick? Or can you only type?
He has a green mic, but I don't know. It doesn't seem.
He's going to try to speak. Let's hear him out. He says it's 1 a.m. or if not, we can leave it for another time. Okay, if you're out there, Patrick. Sorry. Okay.
Trying.
Oh, you there, Patrick?
Can you hear me?
Yeah, we can hear you.
Okay, so that's fine. So hello.
Hey, man.
Well, first of all, this hedging algorithm I wrote myself.
Yeah.
It's basically only for forex, because obviously, as you said, GG, it's all dangerous and all that. And I lost around £10,000 on trading with this wrongly. So it's all stress tested. That's why I'm saying I'm trading hybrid system, because I cannot let it run by itself.
Yeah.
Due to the fact that this hedging algorithm has to be applied only in certain times, let's say consolidations or breakout from consolidations. So what will kill that hedging algorithms and
what do you mean by hedging? Like putting an opposite position in the same currency?
Yes.
So are you aware of the whole discussion on the internet about how this is not actually hedging, but it's just a flat position?
Well, it's not. Yeah, in the end of the day, it's gonna be a flat position. Yeah.
Well,
So let's explain to the audience here. In the forex market, when people say hedge, a lot of them, they mean that, for example, if you are long one contract on the euro dollar, they mean that you put a short one contract on the same instrument, the euro dollar. So basically, they hedge it. They opposite.
But bigger size.
Well, yeah,
but a bigger size.
But Gigi, let's hear how Patrick go for a second, okay? Go ahead, Patrick.
So for example, what you have to imagine pips, right? For forex. So for example, we have a range of 30 pips, which would have been a stop loss a long time back. So now the stop loss, instead of stop loss, I'm my older algorithms opening opposite position in opposite direction. And size is also calculated. Everything depends. So size is something bigger. It has to be calculated. I can't tell you that right now.
No.
How much is it? But the size is some in position is bigger than the previous initial position. And when it's gonna go down, it will the gain from the new position will overcome losses from the previous one. For example, as well, you can calculate that whatever you want to be. I have the setup to be 3 times bigger than this, for example, 30 pips. So when the hedging position will be opened, the move will be 90 pips from this point. It will come to zero. So it will equalize. If it's gonna go up again, another position again will be open, and so on and so on and so on until I'm broke. That's why, because the margin, you got the margin, and you will use all your margin, and broker will not open another position. So this is dangerous, because you have to always open another size bigger than the previous one, and this will grow and grow. That's why it has to be used. I can use it. I mean, you have to be certain that the consolidation will not last forever. So you cannot open at the beginning of consolidations, or you have to be sure that the movement will come, like volatility will come, like some sort of news, which will create that at least whichever way 100 or 90 pips move. So I can open before that, something like that. But anyway, so that's how it is.
Well, thanks a lot for putting that out there. What do you think, Gigi?
So just to explain for the audience, which I don't think they understand what Patrick is doing. For example, in the US, it's forbidden for brokers to accept this practice.
Yes.
So the US has said that the brokers are using this as a scam to make traders pay more, because you basically pay more spread. And in US, for example, when if you are long one contract and you short two contracts, the US law requires you to delete both position and to enter like a new -1 position, right? Like in the stock market. So the US doesn't allow US brokers to have at the same time in the same asset position in different direction. Just like in the futures market or in the stock market, you can't be both long and short Apple at the same time in a E-Trade account, right?
Okay.
So I'm using Dugas copy, so that's Swiss market.
Basically, European brokers allow this because there is a very, very large request from the traders. Traders want to have this ability, which is not present in professional currencies. For example, LMAX doesn't allow hedging, this so-called hedging, and big brokers don't allow because it doesn't make sense from a mathematical standpoint. I mean, if you are long one contract and short one contract, you are on zero practically. But this is harder to understand, so yeah, this is about it. So it's basically forbidden in the US, this practice.
Anybody else want to chime in?
Yeah, can you hear me?
Yeah, go ahead.
Yeah. It's very interesting to me that this conversation came up because I've been spending a lot of time doing this. And I'm in the US, but I'm using Interactive Brokers and I have two different accounts. And I'm trading long futures and short futures against each other.
Oh, wow.
And I mean, I'm still just paper trading, and I've been working really, really hard to find an algorithm that works solidly. So unfortunately, I was listening to Patrick on my phone, and the call dropped, so I had to switch to the microphone.
Yeah.
And so I missed the meat of what he's doing. But it sounded, Patrick, it sounded like you're still directional. You have delta going one way or the other, right?
Oh yeah, it has to. Yeah.
Yeah. So, I mean, what's the difference to you between having the difference as your only position versus having one larger and one smaller against each other?
Well, maybe I'm not so bright, but I don't understand what you mean. So.
It's a psychological thing. It's very hard for many traders to take losses. So they don't want to take losses. So they hold both positions in the idea that they will close both positions profitably. So in this way, you don't have to take losses. So it's a psychological trick.
So
no, it's not like I will profit with everything. One will be, for example, minus 1,000 pounds, and the other one, because it's going to be bigger in lot size, gonna gain me 1,000 pounds. They will meet up in zero point, where I will close both automatically. And
which is exactly what I said. You don't want to take the 100,000 loss, so you just using hedging to close it both on the zero, right? So it's just a measure to not take negative losses.
Of course.
But you also didn't gain anything. I'm trying to understand where's the real advantage. I mean,
the initial. There is a system, trading system, with all the rules. You guys do whatever you guys do. The same as me. So, for example, previously I had 30 pips or whatever pips stop loss. Instead of stop loss, I employ the hedging algorithm there instead of exiting. But if my trade hits take profit, then I go take profit, right? So
Oh,
So
so you're,
there is initial position to be making profits, but whenever it's gonna go against me, then the hedging algorithms, trades.
I see. So you're basically just locking in the difference between your two positions, and it doesn't matter what happens after that.
Yes, exactly. And actually, it matters because if it's gonna be at the beginning of consolidation, or I will know that, for example, I will open something on Friday, and I know that next week Thursday is very important meeting in the government bank or whatever, very important meeting. So I know that from Monday onwards there will be consolidation. Markets will wait for this outcome of, for example, rates cuts or QE or whatever is going on. So if I opened a position and I hedge it on Friday, then I have 4 or 5 days possible consolidation, and that will wipe out my account, actually margin. So many positions will be opened one after another, and each new position is bigger than the previous ones.
Yeah.
You're
Which,
using martingale, right?
yeah, martingale, is that what you just said?
So Patrick, when you say that each position is bigger, do you double the size of the position of each
Yeah.
position?
No. Everything is calculated for the level.
Are you using a grid system?
No. I don't know. I never checked any of these. I heard about martingale, but this is doubling, whatever. But it's like, for example, I don't know where I have paperwork. I'm not ready to talk about that, so I'm not prepared with my paperwork. But there is depending on how much you open in lots, how much you want to. How many pips you want it to be run, so that everything you have to take under consideration and calculations for this algorithm take all of that. Also spread, because not on also spread. I forgot how to say that.
So you said that you are on a Dukascope, right?
Slippage, yeah, also slippage, because sometimes the new positions are not opened exactly where they should be. So there is another one inside that algorithm which just takes that slippage as well under the consideration. So it adds that to all the computations to get out whatever has to be done. So whatever, I can be ready for next time, with all answers.
Oh,
Yeah, hey, Gigi, you mentioned a grid system, and that sounds very much like what I've been working on. Can you tell me?
So I wanted to ask you actually, why are you trading two accounts in different directions? So
Well,
are you using a grid system?
Yeah, I think so. I mean, that sounds like the kind of
So
name that I
basically,
would,
do you short each 10 levels going up, and do you buy each 10 levels going down?
basically that kind of thing, yeah.
Or a different way to say it, are you at each level opening both a short and a long position?
Yeah, basically, trying
So this
to
is a grid
basically
system.
profit from the movement, not from choosing a direction.
The problem is with so-called, I forgot the name, hanging trades. So the trades which will hang at the bottom or the top of the range. So
Yeah.
this is the problem which kills most grid system when a trend starts. So you on the oldest, the lower or the upper set of trades will lose all the count if the trend is strong.
Yeah, I've been banging my head on this for a couple of years now. So I feel like I'm trying to defeat thermodynamics.
No, this works. Market makers are basically using a grid system. The thing is, you have to apply it on when the market is ranging. So this is
Yes,
the key.
and actually where I've been seeing the most opportunity is after hours. Like right now. The
Like
market
in the Asian market when the currency slip. No, this is what market makers do. So market makers are basically using a grid system, but of course it's a much more sophisticated one. And
Yeah.
also what I'm trading on the Swiss, it's kind of similar to a grid system, but I only take trades in a single direction. So yes, this can work, but you can't deploy it anywhere and any time.
You mean like during trending markets you're in trouble?
No, you can't just put it on every pair you have, and every time on the euro dollar, for example, just put it and start trading. You lose money this way. You have to figure out the market regime. You have to know when the market is ranging and when the market is trading.
Right. Okay, so if I research grid system, will I find this kind of
Now, you
material?
will not find anything on the internet to work because everything on the internet regarding grid systems doesn't take into condition the state of the market, the regime.
Okay.
They trade all the time, whatever, you just set it up, like what's the distance between levels, how much money is left, and you just let it go.
So where
Yeah,
where would you suggest I go to research this?
For example, you start researching on market regime. Look up this on Google, how to detect the market regime. So let me put it how it's spelled here.
Yeah, Gigi's a wealth of information here.
So if you are able to detect that we are in a ranging market, then you can deploy a grid system. And if you can use implied volatility for this, of course it's a complicated discussion. But regarding machine learning, this is actually what I want to do with machine learning, to detect the regime of the market. So when
that's
Yeah,
a big,
not a
big
simple
job.
thing to do, but can be done.
Did you say it can't be done?
It can, but it's not simple. I mean, wait, you first have to define what you mean by market regime. And that in itself is...
Yes, exactly, because for example, I want to use my algorithms to search the regimes, and I actually have to define this. So I have thoughts about something to define it, and I think it's similar to the patterns that London Fund talked about, because it kind of sounds like what he was talking about, like having a pattern. So basically, I try to detect some patterns in the market.
Yeah. So in other words, you're probabilistically detecting the pattern of market regime.
Yes, it's a conditional probability which takes into account more factors like the market hour, because like Lee said, between the New York and the Japan market, the Tokyo market, there is a very low volatility period. So it's much more likely for a ranging regime to be found there that is going to be found at the London Open. So London Open, pretty much every day it's a big move. Unlike, for example, in the dead of night. So,
Right.
so my search will take into account the hour and a lot of other factors.
Yeah. Yeah.
Including the price section. So I will look at conditional probabilities taking into account recent moves. Because after a big move, it's much more likely to have a ranging market than after a ranging market. So,
Right.
Yeah, that's very true.
We got a comment here from Mike. Regulatory arbitrage. Many firms are trading through London, for instance, instead of the U.S. for futures effects. See the London loophole. Even oil traders use this in 2008. Also, MF Global used London accounts to get by the restrictions on client capital on segregated accounts. Any comment? I think we talked
for the big guys. So
Yeah. That brings me to let's go here on question 8. I don't know if this is applicable to anybody, but for a bullish view, does anyone use a long defensive like oil, since they're more sensitive on the business cycle? And how about the opposite? Anybody do anything like that at all? Right here.
So it's interesting that you said oil, because oil kept going down while the market kept going up. So
Yeah.
Seems like that's something Paul Cantrell would do, is use oil as some kind of defensive hedge.
Yeah. Well, we'll talk about that in a second here. Anybody do that at all? Okay. Do you believe in self-imposed trading limits when deploying X amount of dollars on the long versus the short? Will it keep within the position trading exposure limit if the market drops a certain percentage? If that was the case, would you deploy more capital on the short side, as the long side should outperform? Anybody got any thoughts on that? Anybody? This can be
I thought
applicable.
we discussed the first part of this, I thought already, right?
Not really.
So
We kind of discussed the first sentence.
Right.
I don't understand the last part. That was the case. Would you deploy more capital on the short side, as the long side should outperform? What does that mean?
Well, basically, if your long side is expected to outperform, you'll need to deploy more capital on the short side to balance it out. No.
But if you are sure that the long side will outperform, shouldn't you put more capital on the long
Yeah.
side?
That's what I was thinking. If you already know that, you put
Doesn't
capital.
make sense.
Okay.
I didn't understand that. Yeah.
Okay. I'll correct that. It's good to know. If I don't know if you guys are using beta ratio for your upper level, what's the tolerance you allow? How do you adjust both sides of the long and short? And what happens if your trade becomes capital hungry when the short exceeds your tolerance? Does that make sense?
It definitely makes sense from where I've been coming from with the whole grid. I mean, with a grid kind of system,
Yeah.
you care a lot about beta. Like, volatility is your friend. So, and yes, when you get too far one way or the other, you get into a big balance issue.
Okay. And then the question.
What do you mean by beta? I mean, Patrick.
Patrick, you want to answer that?
What do you mean? What about beta?
That he wanted to know what the beta was. Gigi, do you know what?
No, I didn't calculate beta for that, and I don't know what.
Oh, sorry.
what you
Oh,
use
it
for.
was somebody else. Sorry, that's somebody else. Go ahead. Anybody?
I think I got the wrong guy.
Yeah,
Oh,
we did.
sorry.
We did.
Were you talking about me? Because I was just talking about that?
Yeah, that's exactly, yeah. Go ahead.
Yeah, so, I mean, the only beta that I know of is the beta that measures how a stock moves in comparison to the market.
Right,
Exactly. And you talked about the grid system, I think, in relation to the forex market, right?
Well, I've been doing futures, but I've looked just as much at forex.
Oh, this is why I asked, because I didn't understand what beta in the forex market you talked about.
There is no beta, I don't think.
I was really just using that term because I understood it's talking about volatility, but yeah, it doesn't really apply.
Beta is the correlation between two assets, so like the stock market and the specific stock, for
Yeah,
example.
this is exactly.
That's related to volatility.
Yeah, this is specific to stocks. Anybody have any other thoughts on it? I think Mike asked, do you use ticks for a grid system on your 1 hour bars, and what's the time horizon? Anybody got an answer for that?
I mean, if
Everything's
you're asking
very-
forex, then yeah, exactly. Depending on your system and strategy. I'm actually personally trading 1 hour bars. Yes.
Okay.
I've been looking at minute bars, and so I'm trying to scout basically.
What kind of bars did you say? Meetup?
Minute.
Minute bar.
Okay. All right. I don't do any grid systems at all. Okay, so we were talking about something before. So let's say if you're using 2 shorts, 2 longs in a position, or X longs and X shorts to hedge out risk, would you add an intersector trade to hedge out the sector risk?
What is an intersector trade?
Do you
Never
know?
heard of this.
Does anyone want to explain
It's
it?
like
Go ahead.
it's like another trade in the different industry, different
Exactly.
completely different assets.
Yeah.
Just to whenever you predict that something might correlate with some other things you use for your hedging, so you can gain another position somewhere too, because those 2 shorts and 2 longs will equalize hopefully, so you can get some gains from different assets. Is that what you meant?
Exactly, it is. Exactly that.
Oh, I just meant the terminology because I never heard of this intersector.
Remember, we're talking about stocks here.
Yes.
Anybody got any?
Most quant funds actually trade like huge basket. They try to hedge out the market, sector, country, currency, pretty much everything. So they have like huge basket that they trade long and short. So not only 2 stocks. So.
No, I know. That's why I have here X longs and X shorts. But does anybody doing that right now and an experience, they want to talk about it? Anybody? Okay. Coming up to last two questions.
Yeah, actually, I did that. I did that once.
Okay, how did it go for you?
So no, it was actually, yeah, all good because it was correlation between. So I had hedged this algo run on euro dollar position, and then I had correlated USD franc, and there was nice price action, and everything was screaming fundamental. So I took another position separately. I shouldn't because it's not in my trading plan, but then so the euro dollar equalized to zero, and I earn money on USD franc at the same time.
This is the same as trading the euro Swiss, so euro franc, because the two positions cancel against each other, the currency. So of course, if they are the same size.
Russell came back with something interesting. Some brokers don't allow short and long open on the same account. Interactive Brokers is one of them.
Oh, actually, it's illegal to allow this in US, so you can't offer this in US.
Merrick.
Right, I'm using 2 different accounts.
Yes,
Jeez.
but in the same account, it's not allowed in the US.
Yeah, it's physically impossible. Like you try and open a short against the long, and you just close your long.
So it's interesting because my FXM account, for example, allowed this, but there is this change in their web interface, and I switched it, so it's not allowed anymore. So if I try to go in the other way, I just close my previous position.
Yeah.
Because I actually like trading this way.
You learned something new. Did not know that. Okay, overall, how do you calculate the weighting of your capital being put to work on the long and short? And he uses, again, beta ratio spread calculations to help with this. So how do you guys weight the capital on your long and short? Anybody got an answer for that?
That's too complicated to explain.
I'm going to put a video out on that. But go on. Anybody at all?
No, I'm not. I can be ready for next time with explanations and calculations.
Yeah, it's
I
all.
friends of mine, still in San Francisco, who manage equity funds, and they rank all their stocks by beta. When the market's moving against them, and they sell out the biggest beta first.
That's exactly how it's done. You want to expand a little more on that, Jeff?
Now, say he's really concerned the market's going to crack, right?
Right.
It's a long short portfolio
Yeah.
made up of stocks. What he do is he runs through things like beta, and then what he does is, I want to reduce my beta exposure by X, right?
Yeah.
So he might sell at, Apple, might have Apple, Google, and they've got high betas, for example, and he'll sell out, say, 2 of them, right?
Yeah.
Just to reduce his overall beta down if the market's really getting nasty with the downside. And he hasn't had an opportunity to put on a lot of shorts, right, ahead of that time
Yeah.
of stocks.
Yep, that's exactly it. Here, Russell also put this right here. Net exposure equals minus or long minus the short divided by your total capital. It's pretty well it. Anybody else want to talk about this at all, or do we move on to the next question? We're on the last question here. We've already talked about this a little bit. Does anyone apply currency exchange when applying a short and applying a short and a long trade over different geographic regions? So I'm talking about different, let's say a euro with a US dollar, and how do you hedge out the currency exposure risk, and is it even worth doing? That's the key for me. Anybody have done that in the past? Go ahead, Jeff.
I hedge out all my currency risk. So it depends. I always pick the base currency I want to, have my accounting with
Okay.
the broker.
Yeah.
So if I think it's going to strengthen at the moment, I'll bring it back into US dollars. In the last 4 or 5 years, I've had it in euros, for example, right?
Yeah.
I'll be net overexposed in the currency, right?
Yeah.
Or what I'll do if I'm doing spreads between each other, just on a trading position, I always watch what the forwards and interest rates are doing in both those markets, because that currency exposure.
Yeah. I never thought of that. Quite brilliant. Jeff, your wisdom.
So are you opening a position to neutralize the currency exchange, or are you just looking at the interest?
No, I'm taking a view on the view.
Practically, you are also trading the currency practically, right?
that net currency overlay on my portfolio. So on bonds, right? So if I have a lot of exposure globally in bonds, all right? And I think, for example, my broker's account is denominated in US dollars, I'll switch the brokerage account across to euro because I was negative for the last 4 years on US dollar. And recently what I did was bring it back, for euro back into US dollar. And now my account's back in US dollar again.
But this is just trading your account. This doesn't, you're just taking care of it.
Currency overlay, right? Seeing what the base currency is, right, of the whole portfolio. But the underlying assets of that is bond.
Okay. So basically but this is taking a directional position on the currency because you are expecting the euro to go up or down, right?
Yeah.
So it's not like a hedge, it's like more of a directional trade.
It's like a big, right, from a very, very long-term structural point of view, right? And I just thought, well, if my primary aim is bonds, right, the currency hedging part of it, right, then that's the benefit.
Anybody else got any comments on this? Anybody? That's it. All the questions from my end. Anybody want to add anything that might have been missed in this at all? Anybody want to chime in on anything else at all? Okay, so Mike asked, so grid trading is like market making. I guess Gigi sounds like, if you got a comment on that, Gigi? I've never done grid trading.
Yes, because market makers, what do market makers do? Pretty much all the time they go against the trade, so they pay the trade pretty much all the time. So in this sense, it's like grid trading, but of course it's a much more sophisticated kind of grid trading.
Yeah. People asked me to write a grid trading system and it didn't look too hot, so I stayed away from it. That was for Forex as well. Anybody else got any questions? I'm actually going to look up any links I might have on it. Anybody got any comments on that for grid systems? So based on regime trends.
No, that is my idea of how to do it right. The grid rates you'll find on the internet, they are based on nothing. So you just set a level between the grids, between the levels, and we just run it. So it doesn't take into account anything. Very stupid algorithm.
Yeah, I fully agree. So that's why I do hybrid trading. So you use your brain where to use what.
And all my back testing has proven the same thing. You can't just blindly do it.
Yes, because you'll make money during the range, and then you lose money during the trend.
Yeah. So, what do you use? Like, I've looked at things like ADX and ATR, things like that. What do you find is a useful way of defining trending versus ranging?
This is a very complicated question. So it depends on the asset. There is no universal answer for all the assets. So each asset is individual.
Yeah, from my perspective, I tried some indicators and all that, but it turns out to best work for me fundamentals. As I said, if there is important data coming on Friday, Thursday, I can suspect that from Monday onwards it's gonna be more flat, and the decision will be made and direction will be established next week after the news or something like that. So I try to use this sort of approach, fundamentals.
Okay, so not even really the fundamental values so much as using the events to decide when it's safe and when it's not, right?
Yeah, like opposite of it, because you're not supposed to trade during the news, but I actually trade before the news, knowing that nothing major will happen, because they're all waiting and scared to put money on the table.
So how do you know before the news if the news won't be big?
No, of course, I only trade this sort of system when I know that there's like important QE decisions, or I know that there is a rate cut coming or not. Those sort of important bank meetings, only those very important meetings, like Yellen.
But you're flat
Maggie.
during the announcement, right? You're saying
Yes,
so you're
I'm out.
leading up to it, and then after it's settled.
Yes, of course, I'm out. I'm just saying, try to predict when it will consolidate.
So this is a problem because if you back test and you don't, in the back test you don't go out during the news events, it means that your back test takes into account the moves of the news events.
Yes,
You
no,
don't actually
back
trade
test-
on that.
Are useless. Yeah. I mean, they not, but I mean, I do back tests, but then obviously I take when the drawdown.
How do you do
happened.
back test? Do you do the back test in MetaTrader?
No. Backtesting in the JForex platform.
Okay, this
Actually,
kind
no,
of backtest
platform
are
now.
not actually. So when this is not an actual backtest. So a backtest implies much more, like doing cross validation, doing sensitivity analysis, doing.
No. Yeah, I'm talking about only simple outcome.
Okay, so this is why you say that they don't work, because this kind of backtests they are not good. They are not an actual backtest. So of course they don't. You can have a very profitable system on this kind of backtest, which you lose money when you play it for real, because it's actually overfitting. It's not a real backtest.
No, that's what I said. When you to optimize it, when you optimize it and all that, what my backtest only has to show me when and why drawdown happened or the losing trades happened, and then I work on that to improve. And in my system actually, loses when it's doing consolidations. So I try to find out when consolidation might happen, what caused consolidations after huge moves or waiting for data, etc. So to avoid consolidations, that was the first goal, to avoid. And then I find out that this is really profitable to trade those consolidations, because it turns out to be right most of the time that these consolidations would happen, because that's what I said. But I'm not aiming to get rich quick, so I'm only aiming 30% a year. So that's it.
30% return will get you rich pretty fast.
Well, a year.
That's pretty good still.
Yeah, I know. That's why I'm saying. I previously was traded 120 a month, and then lost everything and so on. So
Yeah.
there is a long trading history behind me. Now I just want static 30%.
Yeah. Mike asks.
So I'm risking.
Mike asked, that does 3 times the performance of hedge funds. Who can't beat the S&P?
I know.
Actually,
Well, I have to say that it's very easy to make big returns when we are very small, because you can trade on the tiniest of moves. So you can scalp even a single pip, for example. It's very hard to do if you have billions in your account. So this is why it's very possible to have a very large returns when you are small.
well, for anybody who missed the earlier part of this, there's the Anthony Robbins interview. I just put the link here. He says that only 4% of all market trading pros, only 4% beat the market. So that's how miserable the stats are.
I
Any,
don't know what to say, but 30% is like cake easy. I mean, it's like silly easy.
yeah, but that's pretty consistent over 20, 30 years of trading, right?
Yeah, that's the hard part.
Yeah, that's what I'm referring to. There's only very few people actually can do that. Anybody else got any questions, criticisms, comments, anything about tonight? Coming up just over an hour on this for tonight. I learned a lot from this. I appreciate you guys being part of this. I really do. Thank all the input contributions. This really helps me out for my system. Anybody got any comments or something? Anything at all? If not, go ahead.
Final. Yeah, the final comment is why I'm here actually, because I went to a couple of meetups already, like around 10, real life meetups with hedge guys, hedge fund guys, and all guys from industry in London.
Uh-huh.
And basically, what I learned that forex is for kids, and whatever I'm doing is actually a waste of time. So that's why I'm now trying to learn MATLAB and your way of doing it. I'm following yours.
I appreciate that.
To move out from forex.
Forex is for kids. I mean, and what for professional stocks or what?
No, I mean, no serious investors will invest in forex. They all treat it as a dodgy market, not regulated.
So it's interesting because there are a lot of articles right now which say that a lot of professionals are moving into forex because the opportunities in the stock market pretty much dried up. So they want to diversify.
They want to diversify, yes, but I mean, maybe but not investors. I'm looking at to be like a portfolio manager or something like that.
Yeah, I agree with that.
So no one would really give me £1 million to trade in forex. But futures, stocks, or bonds, they would.
I mean, we got the London quant who's doing quite well in forex. I mean, he's going to diversify as well from talking to him with fixed income and stuff. But he's still pretty well, from my understanding, a big trader still in forex, and he's doing pretty good at it too. Gigi, I know.
Depending.
Yeah, Gigi, I know is doing a lot of FX as well. What's your thought, Gigi?
My thought is that anything that is tradable, which makes money, professionals will trade it. So saying that the biggest market in the world is for kids, I don't know. Consider that, for example, the most profitable hedge fund in history, like Renaissance Technology, of course, is not a hedge fund, it's a profitable trade. They are like very big in everything, very big in forex, very big in options. They are doing like 500,000 trades a day. So, like he said, like one of their managers said that they are trading like 20,000 different assets. So they trade everything. So to say that the forex is for kids when the biggest profitable quant fund in history is trading it, it's kind of silly. I don't know.
What I meant really is that if imagine you're gonna make for 2 years, you're gonna create portfolio and history from your broker that you make 30% a year return, and then you're looking for investor to give you 1 million, 2 million, whatever money. They will all say no to you because they don't trust forex at all. I'm only talking about people from the rich people from the street to give you money.
You are not in the business of making money. You are in the business of attracting investors. So it's a different business.
So that's what I'm saying.
When you're trying to attract investors, you're not trying to be profitable. You're trying to impress them. It's a very different thing.
You can't impress them with forex.
Okay, but what I said that your business is not making money. Your business is attracting investors. I'm not sure if you get the difference.
Mike says that's why hedge funds. Sorry, go ahead.
So this is why Renaissance Technology, they don't attract investors. They trade their own money. And when you trade your own money, you don't care how good or how bad you look.
Not really, because depending how much your money is.
Where they are trading like billions of dollars.
Mike said he's got two. Actually, two just came in. Exactly, that's why hedge funds don't beat the market. Hedge funds are more like a club.
Hedge funds earn their income from the tax, from the 2%, 2% of the assets, 20% of the profit. They don't care about long-term performance. Even if they blow up, they will still keep their money. So they don't care about having performance. They don't care about trading profitably because they trade other people's money.
And then,
yes.
Well, that's why the lifespan of a hedge fund is only 3.5 years.
Okay. So this is the business that you want to be in. You want to be in the business of making money from commissions. You don't care to be profitable, right? You just want to be profitable for 2 years to get some money, make some commission, and then you don't care about the investor's money. So the investor. This also means. Yes. So this also means that the investors are pretty stupid because you have to be pretty stupid to keep putting money in hedge funds which blow up after 3 years. So taking their opinion that they consider that forex is for kids, well, they are kids for investing in hedge funds. So I'm not sure who is the kid here.
It's a different.
I agree with you.
Go ahead.
My concern only is that I spent so many years developing in forex, where now people not want to invest.
Yeah, I think
Because if I would do the same performance in futures markets, they would give me money. But forex, no.
Well, I think what he's trying to say, Gigi, is that people like Forex has got such a bad name now, no different than penny stocks and now binary options. So a lot of the institutional players don't take.
I understand this, but what I wanted to emphasize was that it's just so how to say, it's just amateur investors which have this opinion.
Yeah,
Which they are going to lose money anyway because they don't
Yeah.
understand how this business works. So,
Yeah, that's fine. That's fine.
There's just two philosophy here that we're dealing with. Anybody
hedge
else?
funds basically they scam their investors. This is the lesson. Hedge funds are scamming their investors.
Yeah.
So of course you are going to be scammed, but to be scammed you also have to be stupid. So you can't scam a smart person. A smart person will never invest with your typical hedge fund.
Yeah.
So this is why, for example, Renaissance Technology and hedge funds, why don't high frequency trading first take investors' money? Why don't they take investors? Because they are actually profitable. They are not a scam. They are actually making money. And when you are making money, you don't need investors' money. You are taking a top. You just want your own money to grow. You don't want to grow other people's money, right? When you don't make money and when you are scamming, you just want to take all the money in the world.
Yeah.
So this is why Renaissance Technology doesn't take outside money. This is why high frequency trading firms don't take outside money, and why hedge funds take. Because the first ones are actually making money, and the second ones are scam.
I totally agree with that. But that's why I mean that's why you watch that Tony Robbins interview. It's quite fascinating coming from all these big guys like Ray Dalio, David Tepper, all the big hedge fund managers are all mentioned in that interview.
Ray Dalio is legit, for example. He's black water, or how it's called, black.
Yeah, he actually in Tony Robbins' book he talks about his strategy. First time ever.
So Ray Dalio is like the best fundamental trader, and Renaissance is the best quant trader.
Yeah, Ray Dalio is probably one of the best hedge fund managers on the planet. David Tepper as well.
Yes, which is Bridgewater, but he's trades fundamentals mostly.
Yeah. Russell says a firm might have two different departments, one for trading and one for financing from investors. John just arrived. Hey, John. Anybody else got any comments at all? We're just even Soros stopped taking outside money. Ray Dalio.
Not being profitable, so.
Ray Dalio doesn't take money either.
Like I said, the ones which actually make money, they don't take outside money. So, for example, Buffett doesn't take outside money. Of course, his stock, his listed on stock, which is a little bit more complicated. But
He's more of an
doesn't take
investor.
outside money.
Mike says he's senile for George Soros. And then also Tony Robbins talked to Carl Icahn as well. It was just fascinating what comes out of their mouths. Anybody else got any comments at all? Anybody?
Well, if nobody has anything, I have a really fundamental question that I this is my first time, or it's my second meeting, but I don't normally talk to other people like you guys.
Yeah.
And I come from the world of retail trading, indicators and things.
Yeah.
Would you just give me an overview of what it means to be a quant? I mean, what are you looking at instead of things like moving averages?
Gigi's your man for that answer. Go ahead, Gigi.
So, for example, you are using like time frames, like 5 minutes, 1 hour, right?
You basically go ahead, continue, Gigi.
Oh, I want to say that, for example, regarding retailers all use clock-based time frames, like 5 minutes, 1 hour. Some of them are using range-based, like Renko.
Yeah.
So, for example, a quant uses non-linear time frame. So, for example, I'm using a time frame which flows at the rate of the market. So, like you said, in the middle of the night, European time, when the markets are basically not moving, my time frame moves very slowly. When London opens, when big activity starts to happen in the market, my time frame would move much more quickly. So this means that this better be if it's wrong, but if you imagine like there is a move in the market, on a retailer kind of time frame, you will see like a broken line. If you will see a very small move during the night and a very big move at London Open, so the line will be broken. It will fall slowly and then it will fall big, steeply. But if you use a non-linear time frame, the whole line will be smooth. It will be a single line. Because my time frame goes at a different speed, in the middle of the night it will move very slowly. So there will be very little bars, for example. And when London will open, there will be more bars because the action is faster. So the line will not be interrupted. Will be so the idea is that when using a non-linear time frame, for example, things are behaving more regularly than when using a time-based time frame, for example. And there are studies about this. For example, you might know that the returns of the market are non-Gaussian, so they don't follow the Gaussian distribution, a normal distribution. But if you use a non-linear time frame, which is based on the volatility in the market, they will follow a normal distribution.
A couple of questions came up for you, Gigi. Mike asked, so switching between 15 and 1 hour bars, Gigi, based on session?
So no, I don't switch. I don't have 5 minutes or 15 minutes each. Well, I don't have bars at all. But to use this technology, I would have to have bars. In the middle of the night, one bar would be 1 hour. And at London Open, 1 bar would be like 2 minutes, for example. It would be variable length bars. But I don't use bar, I only use ticks. So.
And what about...
Wouldn't a tick chart be comparable to what you're talking about?
Excuse me?
A tick chart, when where a bar is like 377 ticks or something like that?
A tick chart will start to approximate this because the rate of ticks in the market are very correlated to the volatility. So yes, if you are going to use a tick chart, you will get this kind of thing.
Okay.
But the problem is that most tick charts only show like the last 1 or 2 hours, so you see very little on it.
And John's comment, time frame depends on the volatility though.
In this kind of time frame, which I said, like a volatility time frame. But if you are using a regular time frame, like a 5-minute time frame, then it will not depend on the volatility.
Okay.
So, in reference to my question, there's more to it than that, though, right? I mean,
of course, but this is one kind of things that quant use. Quant don't use, for example, regular time frame. They try to research more sophisticated time frames. Or they don't use a regular exponential moving average. There are more sophisticated kind of moving average. You said about ATR and ADX. For example, average true range, right? That's the kind of, instead of using the average true range, I use implied volatility, which is pretty much the same thing, but much better because it takes into account predicted future events, like a known news event. ATR will never take into account a future event. So,
another... Go ahead.
Sorry, I have a question about this. You mentioned in the previous one, the Saxo give that.
Saxo gives implied volatility, yes.
Yes. But do they provide API?
No. Well, nothing is for free in this world. Sometimes you have to work for this. So you can buy, if you want to API, there are some which are selling implied volatility fees. So you can get an account there, like IV volatility, I think it's one for.
I'm just gonna dig into it.
IQ feed's another one.
If you want to get it for free, you can use Saxo Bank for the major. If you want to pay, you can use this site, for example. You can buy them from historical in real time. You can buy from here. They're not very expensive.
Yeah, IQ
but you
feed.
have to pay.
Yeah. And there's IQ feed as well, or what did you just put in there? A question from Daniel asked, if you use range domain range bars, would it have any similarity
What
to...
I talked about is very similar with the range bar, but it's a better kind of range bar. So it's hard to describe the difference.
There is also Heiken and Ashi as well.
Yeah, I can ask you also.
Did you see Mike's question here? How often do you trade, Gigi? I think we've covered that lots of times.
I trade like once every 2 or 3 days right now because, like I said, it's manual and it's a more complicated kind of trading. But when I will trade algorithmically, it will be much more. Right now I don't trade very often.
Anybody else got any questions at all? GG's the man. Anybody? Comments? Oh, another one came in. A topic for another meeting, something that may be interesting, is a committee of traders reports that's published by the CFTC every week.
So I'm using for Forex, I'm using a real-time discount. So for example, at FXM and other brokers, you can see in real time how much traders are long, how much traders are short. So this is another kind of input that I will input into the machine learning stuff I talked about earlier.
Yeah, and from Jeff, I liked what he posted last week from the New York Fed. That was really good. And how much the U.S. Fed is going to buy each day. I think that was brilliant.
Thanks, Brian.
No, that was awesome, dude. Thanks for contributing. Oh, more questions came in from Mike. How do you manage stops, and what are you getting? Where are you getting this from? Okay, so two different things.
For Russell, I assume that he talked about the positioning. Some brokers like Dukascopy, like FXCM, like Wanda, they make public this kind of information. How many are long, how many are short. So let me show you one example of this.
Yeah, just so people understand, for anybody who's new to this group, Gigi's posted some amazing stuff in previous videos on my YouTube channel. I'll put that in if you need it. Go ahead, Gigi.
So about the stop
Yeah,
question, if it asks me, like I said, I have a single stop below the limit level of the Swiss National Bank, so I don't kind of know that.
I'm just pulling up that chart, Gigi. Hang on. Hang on here. Yeah, I think we've seen this before.
Yeah.
Go ahead.
So I collect this kind of positioning information, and I have a very strong belief that they correlate with some moves in the market. So this is going to be input in my machine learning.
Oh.
Yeah, but what do you think? Is it not a problem for you that this is only Oanda,
But
clients?
I also have FXCM and Dukascopy. And are you familiar with the concept of exit polls, like in election?
Mm-hmm.
So you know that in an election they actually ask like less than 1% of people, and from that 1% of responses, they can get a very good result of the whole people, right?
Yeah.
So this is the same thing. Wanda and FXM may be only 1% of the market, but they are representing the whole market because it's like an exit poll.
It might be, yeah, but whatever. But my feeling always was about this that retails.
Okay. FXM, for example, FXM trades like 300 billions per month, and there are a lot of hedge funds which smaller hedge funds, smaller banks, which trade through FXM. So it's not only retail traders; they also have hedge funds trading through them. So you also get some bit. So in a previous example, I personally saw, because FXM also makes available volume information. I also saw one guy which traded $200 million position on FXM. So when you can trade a $200 million position on euro dollar, you're not a small little guy.
Well, I guess
So that guy made $600,000 in 3 hours.
So yeah, that's what John says here. These are retail traders, so they don't move the market.
Well, the latest Bank of International Settlements study, which they do the statistics on the whole forex market, retail trading is between 5% at the lowest and 30% on the Japanese yen, for example. So at 5%, retail trading is like a smaller bank, like they say the 4th or 5th bank globally. If you believe that, for example, I don't know, not UBS or Deutsche Bank, but if you believe that Merlin, like the 5th bank in the world is important, then retail trading is also important, because retail trading is the same size as the 5th bank in the world.
Yep. Anybody got any comments on that or chime in?
Yeah, basically crowds always stupid.
Yes, but you can't use this to predict what's happened. This is the interesting part. Because you can see that in this chart, for example, that, I don't know, 90% are long or short something. This doesn't mean that it's going to move up the other direction. What happens is, which is what we talked about earlier. Losers, so traders which are having losing positions, they don't want to close the losing position. They are keeping it. So this is why you get to this high percentage of positions. But that doesn't mean that you can take the other side. However, you can use this information to predict when stop hunting will happen. So.
Yeah, some other comments came in from John. Too expensive, and you go through a PB and get a charge 10. If you can.
I mean, this is about size. The bigger you are, the less you're going to pay. So.
Yeah. I just put a note in for Mike. He's asking about stop loss. I cover that in my YouTube channel a lot. There's a lot of. You can just search on my YouTube channel for that. Anybody else got any questions at all? Anybody else? Up hour and a half. So Mike has put up this link here. Let me just pull it up.
Okay, so now from Wikipedia to show that's the slowest. So for example, even more interesting. So this is the size of these banks. So retail trading is doing more trading than Goldman Sachs on Forex.
There you go. Let me try to pull this link up. Come on, baby. There we go. Okay. What page are you referring to, Gigi?
Excuse me?
What page are you referring to? Or no?
Wikipedia, the biggest traders in the world.
Okay. I missed that. There you go. John just put a question in there. Get a major volume of FXCM doesn't come from clients from their market making.
I don't understand the question. So.
I think he's just saying that they make most of their money from.
They make public the whole volume, so everything which goes to them. So I'm not sure what.
Yeah. I'm gonna go to page 7 here.
Actually, FXCM is now moving away from retail traders. They increased the lower the minimum account to $2,000, and one of their representatives told me that they are probably going to increase it to over $10,000. So they are not. They want to move to the larger traders. They don't want to trade with small traders anymore.
Makes sense. Anybody else got any comments at all? Just over an hour and a half. Anybody? Questions, comments? I don't know if you guys got my for next week. This one's kind of going to be important to me in the next couple of months. Basically, just give me a second here. Let me just pull this one up. This meetup's a different one. It's for retail trade, for the relationship between options data, futures data, and how it interrelates with everything, specifically in my case, equity market. So we can give a good talk on that one. Anybody else got any comments, questions at all? We do this every Monday. I've got topics lined up all the way to November 17th. Who's interested in the machine learning one on November 17th? Here's the topic. Does machine learning actually work?
I think what you want to say, if it works for trading, because it works in general.
Yeah.
And I think the problem is yield post, because machine learning works. The thing is, can you put your trading ideas into some sort of model which is usable in a machine learning way?
Right.
So the problem is not if machine learning works, but if you can express your idea in something which is usable using machine learning.
Okay.
I think also resources, like how to get all the resources fetched to it, like all APIs from all, take this under consideration, take this, take that, take this.
Well, this is not related to machine learning. This is more like related to general programming. So.
Okay. Yeah, there was a comment came in from Daniel. Keep going, guys. I'm going to pull that up on what Lennon Quant said about what he thinks about machine learning. Go ahead. Continue, Gigi.
What I said, getting data and calling APIs, this is not related to machine learning. This is general programming. So you can do this even if you don't use machine learning.
Right. Just going to pull up. There was a quote posted by somebody. Just give me a second here. Just got to pull it up. Yeah, I'm just going to...
You do everything in Python?
Pretty much. I also have a little C++, a little C#, a little Mathematica, but over 90% 5% is Python.
This
And
keep going.
you're doing the machine learning stuff in Python?
Yes, Python has very good machine learning libraries.
Okay.
This is what Lennon Quant said, and he's exactly right. Machine learning models do work, and there are plenty that are absolutely useless for trading. If, for example, search on signs direct to neural networks and trading, you'll find thousands of articles. Some of them are excellent, and some of them are interesting, and a huge pile of them are pure scientific masturbation.
So, for example, what I want to do, I want to use machine
sorry.
learning more to detect the regime of the market, not to. So, with the output from the machine learning, I will use that as input into another kind of algorithm, and that will do the actual trading. But machine learning will just to detect the correlation, not to do the actual trading.
Yeah.
So,
And Mike came back with a couple of packages for Python, PyBrain and Scikit.
I like it learn. But I didn't got very deep into this because, like I said, I have some stuff to do before this.
Right.
And I also use Mathematica because Mathematica is also very nice for some stuff.
Yeah.
And I can call it easily from Python.
Yeah, I'm a MATLAB guy. Anybody else? I do know MATLAB's got a pretty good neural net toolbox. That's really good. Apparently, a lot of people like it. I haven't really played with it a lot.
I like in Python that you don't, for machine learning, you don't need to understand how the algorithm works. You just give you the data and it gives you the result. You don't have to do any kind of operation. It's pretty much automatic. So.
Yeah. There's another cool one. If anyone's never used the scientific identification for MATLAB, it does use a form of machine learning. I'm just going to pull it up. Identification. It's another toolbox. It's quite fascinating what they've done with this one. Let me see here. I'll find it. Keep going, guys. Anyone use Orange or Python toolbox?
I never heard of it.
Yeah, sorry, it was called system identification.
So this is like this is not relevant. I mean, what you use it. The idea is how you use it. So
Yeah, it's pretty cool though. If anyone wants to look into it, this is something I'm really fascinated by. Anybody else got any comments or questions at all? What's the beef between Cottrell and LQ about? I call that, in one word, egos. Chime in on the forum if you want. Let them know what you think. If anybody doesn't know that link, it's right here. I can give you that. Anybody else got any comments at all? Hour and 40 minutes. Pretty good meetup tonight. So both will be there. No, I know Paul Cottrell won't be there on the 17th. Been trying to get him. Anyone use Disciples? I don't know Disciples. Anybody? Okay, let me just see this website here. I have no idea what this is. So, and Orange. I've never seen any of these. Anybody have any comments on this? Another one is the Mars splines algorithm published by Salford Systems. There's so much stuff out there. It's to be honest, it's confusing. What do you think of all this stuff, Gigi? I've got my opinion.
What stuff?
Well, just all this third-party stuff that people are listing, and I mean,
I don't know. I can't speak like I would have to investigate. Well, you can do
generally.
in the hardware, like calling directly the algorithm. You can use a GUI like this stuff. Everybody has something from it.
Yeah, I mean, I've been at this for 4 years, coming up in December, and there was virtually nothing that does any of this stuff. And then with Python blowing up with Quantopian, all of a sudden there's all these Me Too solutions, and it's like, that's fine, but when you start using these tools as a crutch these will work against you. And I've talked to London Quant so many times about this that.
But you know, for example, that you can apply the same argument for MATLAB, for example.
Sure. Yeah, I don't deny that. I agree with that. Yeah, I agree with that. But I think, though, it's like driving a car. A lot of people just want to get from point A to point B in a luxurious way and in a nice, fast way. But at the other end of it, you still have to understand under the hood all those technologies to really understand.
So not necessarily. Like I said, for example, I want to do a classification. I want to find the set of pattern.
Yeah.
I don't care how the algorithm finds the pattern. If it finds the pattern and that pattern going into my backtest is profitable, I don't care how it found it.
Okay.
So, of course, if I would understand how it found it, maybe I would be able to find a better pattern or something like that.
Yeah.
But you can also don't actually need to understand it. So.
I mean, everybody's got their own interpretation. If you ask me, I'm like with London Quant. He writes all his stuff on his own. He doesn't use any third-party libraries at all. And no, he's never.
I'm also very much like this. I pretty much also like to write my own library. For example, Aaron Max provides a .NET library. I just use it to understand what kind of calls it's doing, but I'm doing the calls myself. So I also like to use my own stuff.
Yeah, you
but
learn.
Not for everything.
Yeah. I mean, like I said, there's different interpretations of it. I have my own. Gigi has his own. Everyone has their own. I think we got some other stuff mentioned here. Let me just see what else we got. I agree. Best to write your own stuff. C# is so slow, which is what Daniel uses.
I think it's so slow for what? So it depends on what.
It depends how you write it. I mean.
No, it is slow. I mean, you can't write a game engine like Crysis in it. But there are very few problems like that. So.
Yeah. I mean.
A lot of times people are talking about how slow is C#, how slow is Python. But they are using tables with 20 rows, right?
Yeah.
How fast is a certain database or my NoSQL solution, but they are using 20 rows. So 20 rows, you can just keep them in memory, you don't need the database at all.
Yeah. So, everything comes down to how you write and how you interpret it and what you're using it for. Everyone has their own opinion on it, really. As long as you're making money at what you're doing, that's really what it comes down to.
So for example, Python is slow. I mean, when I read from CS or from fixed files, to get the data to put into my binary files, it can take, for example, when I do my weekly processing, it takes like 4 or 5 hours. I don't care because I just started in the weekend. I don't need it in 1 minute.
Yeah.
So I could finish it in 1 minute if I were to rewrite that in C++. But what's the purpose? I mean, what would I gain? It will be harder to maintain, and it will offer me speed when I don't need speed.
Yeah.
So,
I hear what you're saying. Anybody else got any questions at all? I'll post all this stuff for everybody. Gigi says, yeah, from Daniel. Anybody else got any questions or comments at all? We've talked about what's coming up next week. Next Monday, same Bat Channel bit time. Anybody else? So we can do. Oh, can you get Paul and LQ together? Yeah, but it won't be pretty. I'm sure they want to do it. They definitely want to do it. They
just to know who is for and who is against.
Let's do that. Who? I mean, does anybody who's new to this to see who knows what's going on between Paul Cottrell and LQ, London Quant? Does everybody knows what's going on? Does everybody know the history of what's going on? It's just basically their opinions.
No.
Anybody?
No.
I think everybody's got their own opinions on it. I think London Quant and Paul, it's just better to put them in the same forum. So you're sorry, Gigi, you were saying no disruptor for you?
Oh, Patrick asked me about disruptor, so.
Yeah. But as I said, if you guys want to see what London Quant and Paul Cottrell comment away on the meetup, comment on the forum posting, that will get them going. If that's what you want to see. I'm trying to stay out of it, to be honest. Anybody else got any comment?
I didn't see either of them. I think I must register somewhere. So.
Yeah. Why do I delete the comments? I don't delete comments, Mike. Nothing's been deleted.
I think he just like me. He didn't show them because they require a login.
Yeah. No, well, on the meetup, yeah, you do. On the Quant Finance meetup, you do. Good night, Daniel. Thanks for coming out. Are you referring you can't log in, Mike? No, nothing's been deleted. Anybody else got any comments or questions at all? We can give it a wrap if you like. How do I see it, Mike? That's what you're asking, Mike. I think Lenin Quant comes from the world of robotics, and he knows his stuff there. Paul's got his own system that he's working on. It's his own solution. He's got his own interpretation on it. At the end of the day, I don't see the right and wrong as it's everything. I could argue with other people about stuff, but at the end of the day, if you're profiting, that's what matters.
So Paul doesn't agree that machine learning works, or
No, Paul is actually for it. I did put up a posting on his proof on it.
Lenin Quant doesn't agree it works?
No, he agrees it works too. He just questions Paul Cottrell's philosophies on it. That's the problem. That's the problem. If you want to see Paul Cottrell's proof on it, I'll give you the link. He's also included a spreadsheet on it. And let me just pull her up. There's this link right here. And this is on General AI. And you can just download this Poseidon AI spreadsheet file. There you go. Another question. I think he was questioning his neuro interface idea. Yeah, that's right, John. Anybody else got any comments, questions? Is Paul's methodology based on volatility? LQ's is based on regime? I don't think it's based on any of those. I mean, again, you'd have to talk to them specifically. Ask away on the forum or the Meetup comments. It's better to ask them directly, not my interpretation of it. I just say I'm just a schmuck. Anybody else got any comments, questions at all? You can give it a wrap if you like. I gotta say thanks everybody. Well, it was good to meet you guys. Thank you, Patrick, for coming out. I hope you guys come out again next Monday. It's growing. We just hit the last 2 weeks our highest volume of traffic in the last 2 weeks. It's been huge. Thanks for everybody making that happen. Thanks all. I appreciate everyone coming out tonight. Trade well, everybody. Well said, Jeff. Thank you, even though I came late. That's okay, John. We'll have the replay up tonight or tomorrow. Anybody else got any comments or comments? I got a favor for you guys, actually. On the Meetup, either whatever one you come in, I have a review section. If you want this group to get bigger and learn things faster, the more reviews we get, the more credible we look. So we have a group review section here. So if you could be honest, doesn't matter. I'm not looking for if we're bad or good, but if you want to just put a comment in the review section, that'd be greatly appreciated. Anybody else got any comments, questions at all? I guess not. But again, thanks for coming out, everybody. It was a great meetup. Thanks, Gigi. Your input was awesome. And everybody else, thank you. What I'll do is I'm going to close her out. I'm going to disable my recording right now. Thank you, guys.